This is an important video because when you watch CNBC or financial news channels constantly, you hear people come on who say the central banks lowering interest rates will increase inflation, and that is wrong. It's very easy to understand. Lowering interest rates will actually creates deflation, and we can see this both empirically through 30 years of evidence of, Japan, Europe, America trying to increase inflation by reducing interest rates, and it hasn't worked. And we can also understand with some basic understanding of economics. I'm going to try to keep it very simple. It's not actually that hard to understand. We can see why just with basic economic models, understand in theory why reducing interest rates would not increase inflation. I think it's important to understand because everybody on financial channels on TV talk about it like it's a given fact. It's not. Okay? So first, just, we can look around the world for evidence before we get to the theory. Look at Japan. Since 1990, they have wanted to increase inflation. The central banks or governments around the world have issues with debt. Inflation helps a little. They want to increase inflation. They lower interest rates in order to increase inflation, and it hasn't happened. In Japan, it hasn't happened, and they've been trying for 30 years. They were the first one to hit zero, and Europe and the U.S. have also been trying. Inflation has always been lower than they want it. They're just not sure why. We're now at zero interest rates for a lot of the world, and in the U.S. it looks like it's coming. So just in theory, if lowering interest rates causes inflation, zero interest rates should mean a lot of inflation, right? It's not happening. So what's the theory behind this? It's actually pretty easy to understand, okay? First, you need to know, which a lot of you probably know, but you don't think about it, which is we like to say, the central bank prints money. They're not printing money in the old sense of actually printing bills or even printing money. What they do is they ease credit, meaning they make it easy for businesses or individuals to borrow. And who do they loan to? They loan to businesses who agree, or individuals who are going to create value, right? If I go to a bank and say, hey, I have no money and I want to take my family to Disneyland, can I have money? They're going to say no. But if I say, hey, I've got a business and I want to expand and produce more goods and it's going to be great, I'm going to produce at lower costs with my new machinery, or I'm going to be able to expand and increase supply. This is going to be awesome. They'll say yes, and they'll give me money. Okay? So that's what easing credit does. It's not giving away money, which might cause inflation. It's creating credit, which causes deflation. Let me give you a very easy example. Oil, right? So if a company comes to a bank and says, I want to borrow money to improve my oil manufacturing plant, with this money, I'll be able to produce at a lower cost, or I'll be able to produce more oil, or whatever it is, and the bank says yes, the company creates more oil, is able to produce more oil. What does that do to the price of oil? It lowers the price of oil overall because more supply of oil decreases price, or they upgrade their factory so that they can produce oil at a lower cost. That makes the price of oil able to go lower. What's on the other hand, if the central bank is tightening credit and a oil company comes in and says, hey, I want to borrow, I want to be able to produce more oil. They say, well, interest rates have gone up, it's difficult, you can't have the money, or the bank says, or the company says, well, I can't afford to borrow at those rates. They're not able to expand, and this has happened twice, I think, in the last 10 years. I know at least once it was a big deal. Probably twice, where there was a problem, prices go low, and several companies come running to banks. We need more money. No problem, lower rates, keep producing, price of oil stays low. What if interest rates were higher And all these oil manufacturers come in, we need more money, we need more money. They don't get it. They go out of business. There's less oil supply. And then the price of oil would go up. So with this example of oil, you can see that higher interest rates would lower the supply of oil being produced, and a lower supply of oil will increase prices. More available in easy credit allows oil companies to, in some cases, just continue pumping out oil, if not upgrade their plants. So lowering credit increases the supply of oil, and we see lower prices. Very simple to understand. The Federal Reserve lowering interest rates causes deflation, not inflation. So please, when you see this on CNBC, just, it drives me bananas. Send them a comment. If you have friends with any economists, forward this to them. If someone can explain to me why I'm wrong with this, let me know, because it drives me bananas. Why is everyone, at least debate the issue. If I'm wrong, how come I'm the only one, it seems, who thinks that increasing credit decreases prices? I mean, there should be at least an argument going on here, right? Let me know your thoughts.